Krishna, let's start with you on this. There's been a lot of talk over what Jamie Dimon has been mentioning, just the idea that there are storm clouds on the horizon, that this is a hurricane potentially headed our way. Have things changed on the ground from your perspective?
Well, I think what he's referring to is Fed tightening, and nothing has changed on that front. If you look at if you ask yourself, what is one thing that the Fed is looking for in this market with their tightening path, it is some softening of the labor market. And it hasn't been any. Yesterday's JOLTS data basically told you there were two people looking for every job, or there were two jobs available for everyone looking for a job. That's not the sort of market where things stop. So I think that's what he's saying, that Fed is on a pretty established tightening path, and it's not going to stop anytime soon.
Yeah, and Kevin, maybe add to that the idea that odds of a recession are growing, probably day by day, watching what's happening with that, watching what's happening with oil prices, whether or not the Fed's going to be successful in slowing inflation at this point. What do you do when you look around and try and assess what you do in the market?
Yeah, it's a hard question, Becky. I mean, I can make a case that we're already in a recession. And I think of it like, you can't manage a baseball game on analytics alone. You have to feel the ebb and flow of the game. And it's the same with the stock market. You can't just look at analytics. You have to really focus and read the tape. And when we talk about the recession that we're in my opinion, it's just the eyeball test. We're looking at things, gasoline prices, oil prices, energy prices. Everything is so high that I think Jamie Dimon's reading the tape, and I definitely agree with Krishna. It's all about interest rates and how the Fed can help us navigate this.
Kevin, even if we are in a recession at this point, again, that's a debatable point right now. Even if we are, you'll have people tell you that, yeah, you could be in a recession, but it's not going to be a hardcore recession, that this will be something that is maybe quick and we move on from here. Do you think that's the flavor, or are you really battening down the hatches at this point?
No, I'm not battening down the hatches. I don't see a major hurricane, but recessions, like you said, Becky, can come in different flavors. We're not talking about a 1929 recession, your great-grandparents' recession, or even a recession that we saw in the financial crisis or the COVID crisis. But recessions are not that serious if they're minor. Two quarters of decreasing GDP was the old school definition. I know it's different now and we'll be told after the fact, but a minor recession is something that we should be looking forward to investing into, looking for opportunities to get through. And companies that make money and return cash on cash to shareholders, even in periods of high inflation, high interest rates, even, God forbid, a recession, they can still make money and their share prices can go higher. So I think it's about how we invest in this market, not how we trade it.
Krishna, we are getting the jobs report tomorrow, the big jobs report. We got the JOLTS data earlier this week. What does that tell you about the jobs market and what the Fed might be considering?
Well, so every sign in the jobs market, at least so far, is it's still running extraordinarily hot. So I think if the Fed's objective is to soften the labor market, it has a lot of work to do. And that may be a counterpoint to what Kevin was just saying, which is we are in a recession. This doesn't taste, smell, or anything like a recession. We may eventually have it, but it's not today. And the Fed is going to continue to tighten. But the other point that Kevin was making was an extraordinarily good one, which is we are probably going to get a shallow recession. The stresses that we typically have isn't existing in the marketplace, and therefore it'll be a great opportunity to buy some really good companies. Maybe not today because the markets have rallied back, but perhaps late summer, early towards the end of the year.
Kevin, since Krishna got to critique your points, what are his points you agree with and disagree with?
No, he's right. You can't make the case against the unemployment being as low as it is. And without high unemployment, you're going to, definition-wise, keep away from stagflation, and recessions may be a little bit further off. But I think preparing for them beforehand is a better way to think about it. And I'm always looking at the lay of the land from just, a cultural standpoint. What are prices doing and how do people feel? And it sure feels like a recession, even if people are fighting for jobs and employers are fighting for employees. It just feels like it to me. So better to prepare early than to prepare late, especially when you're talking about investing.